If I asked 100 people what the best investment is to become a millionaire, I would probably get 100 different answers. Some people would tell me to buy individual stocks like Nvidia or Apple or Google. Others would say real estate is maybe the best way to build wealth. Some people even tell me that investing in crypto is the best thing, or whatever the latest trend happens to be. But if you asked 100 experienced financial advisors and people that work in finance what they would probably recommend it to the average person who's investing for retirement or trying to build long-term wealth, you'd probably notice something interesting is that many of them would actually recommend the same handful of investments over and over again, and that is low-cost index ETFs. That doesn't mean these investments will make you a millionaire overnight. There are no guarantees in investing, and anyone promising you quick wealth is probably trying to sell you something. But if your goal is to steadily build wealth over decades, history does show that these simple investments, even though they're simple and sometimes people call them boring, have been incredibly difficult to beat. And that is a fact that no one can argue against. Well, what exactly is an ETF? The easiest way to think about an ETF is to imagine you're shopping for fruit. Instead of buying a single apple, you buy an entire basket filled with apple, oranges, bananas, grapes, and dozens of other fruits. If one apple goes bad, in this case a company goes bad, it barely affects the entire basket because you own so many different fruits. And that's essentially what an ETF does, except instead of fruit, it owns stocks. When you buy a share of an ETF, you're usually buying tiny pieces of hundreds or even thousands of companies all at once. Instead of trying to figure out whether Apple, Microsoft, Amazon, or Google would be the best investment over the next 20 years, you simply just own all of them together. And that's one of the biggest reasons ETFs have become so popular. They're simple, diversified, and they allow almost anyone to start investing without needing to become a stock market expert. Look, when you buy a single company, you're making one big bet. If that company becomes the next Nvidia, then congratulations, you're a millionaire. But you could also, you could make an incredible return. But what if that becomes the next Kodak or Blockbuster or one of thousands of companies that slowly disappeared over time? There really is no way of knowing. The reality is that picking winning companies consistently is extremely difficult. Even professional fund managers with teams of analysts often struggle to outperform the overall market over long periods. But an ETF takes a completely different approach. Instead of trying to predict which company will become the next big winner, it simply owns all of them, and that way it can't lose. Unless all the companies lose. But the companies that succeed naturally become a larger part of the fund. Instead of trying to predict which company will become the next big winners, it simply owns all of them, and the companies that succeed naturally become a larger part of the fund, while the companies that struggle become smaller or eventually leave the index altogether. This way you don't have to predict who the winners will be because you're already investing in them before they become winners. And that's obviously a much easier game to play. But now, not all ETFs are created equal. If you're comparing different funds, there are a few things I think everyone should understand. The first is diversification. Generally speaking, the more diversified an ETF is, the less your portfolio depends on the success or failure of any company. If one company has a terrible year, it doesn't necessarily ruin your investment because hundreds of other companies are still working in your favor. The second thing to look at is something called the expense ratio. This is simply the annual fee the fund charges to manage your investments. It might sound scary, but many of the most popular ETFs have incredibly low fees. For example, an expense ratio of 0.03% means that if you had $10,000 invested, you'd pay roughly just $3 per year. And that's less money than people spend on a cup of coffee. And I know what you're thinking, $3 doesn't sound like much, but if you're comparing two ETFs that track the exact same index, it usually makes sense to choose the one with the lower cost because every dollar you don't pay in fees stays invested and continues to compounding over time. Something important to know about ETFs is actually how they decide what companies to own. Most of the largest ETFs are what's called market cap weighted, and even if that sounds complicated, it's very simple. Imagine two companies. One is worth $3 million and the other is worth $30 billion. The much larger company naturally represents a bigger portion of the overall stock market, so it also makes up a larger percentage of the ETF. And that's why companies like Apple, Microsoft, Nvidia, Amazon, and Meta, and all the big companies you probably heard of, usually make up some of the largest positions inside funds like VOO, which is a really famous S&P 500 market cap weighted ETF. The bigger the company becomes, the bigger its weight inside the ETF. So if another company grows over time, its percentage naturally increases as well, so nobody has to constantly guess which company should be bigger. The market itself determines those weights. So if you looked into investing before, you probably heard names like Vanguard, Fidelity, Charles Schwab, BlackRock, or State Street. Many people think these companies create different versions of the stock market, but that's just not really what's happening. You have to think of the S&P 500 as the recipe. I like to think about companies like Vanguard, BlackRock, and State Street, or all these big companies. They're simply different chefs following that same recipe. For example, Vanguard offers VOO, BlackRock offers IVV, and State Street offers SPY. And all these three are designed to track the exact same S&P 500 index. That means they own nearly the same companies in nearly the same proportions. The only differences are actually pretty small. Think like the expense ratios that we were talking about, or trading volume, and the fund structure could vary slightly. But for some investing for the long term, they're all excellent choices. And what you ultimately pick really depends on your personal preference and position in life. So I wouldn't want you to get too caught up trying to find the perfect company behind the ETF. The index the ETF follows is usually much more important than the company offering it. Now, all ETFs don't follow the same S&P 500. There's different recipes that these chefs can follow. Even though the most famous category is the S&P 500 ETF, this is probably what most people picture when they hear someone talking about investing in the stock market. Funds like VOO, IBV, and SPY, like I mentioned, owe approximately 500 of the largest publicly traded companies in the United States. And over long periods of time, this has been one of the most successful and widely recommended investment strategies in history. Another very popular category is the total US stock market ETFs, such as BTI or SCHV. Instead of owning only the largest companies, these funds own nearly the entire US stock market, including thousands of small, medium, and large companies. Some investors also like international ETFs such as BXUS because they provide exposure to companies outside the US, and these funds invest in businesses across Europe, Japan, Canada, Australia, and many emerging markets, giving the investors diversification beyond just one country. There also exist ETFs that focus on companies with long histories of paying dividends, growth ETFs that emphasize faster growing companies, small cap ETFs that invest in smaller businesses with higher growth potential but are more volatile, and real estate ETFs that own collections of real estate investment trusts, bond ETFs that generally reduce portfolio risk, and even cryptocurrency ETFs for investors comfortable taking into more significant risk. Each one has its purpose, and the right combination depends on your own goals, time horizon, and risk tolerance. These are like the chefs trying to make their own recipe that appeals to different kind of people. They might like salmon and another person might not like salmon, but it's just like a good analogy to try to understand this a little better. But if someone asked me to choose only one ETF for myself, I would probably go for VOO, and that's the one I actually invest in the most. But now, before anyone heads to the comments, let me be very clear. I'm not saying VOO is objectively the best ETF for everyone. There is no single investment that's perfect for every person, but your age, financial goals, income, risk tolerance, and even where you live can all influence what makes the most sense for your portfolio. But if I personally had to pick just one ETF and never touch it again for the next 30 or 40 years, I would choose VOO. And honestly, I think a lot of people would fall into this category, and the reason is really simple. It just gives me ownership to the 500 of the largest companies in the US. Many of the businesses inside the fund are companies that millions of people use every single day. As the economy grows, new companies rise and industries evolve. The S&P 500 changes with it, so I'm invested in all of them. Companies that decline eventually become smaller part of the index or are replaced, while the stronger businesses take their place. So it's a strategy that doesn't really rely on me predicting the future, and that's exactly why I personally like about it. That being said, not everyone wants to invest the same way, obviously. So, for example, someone in their early 20s who is investing for retirement might decide they're comfortable owning mostly stock ETFs because they have decades before they need the money. But on the other hand, someone who's approaching retirement may prefer to add more bond ETFs to reduce the ups and downs of the market. There truly isn't one magic allocation that works for everyone, but here are a few examples just to give you an idea. Usually a more conservative investor might own around 60% stock ETFs and 40% bond ETFs, and they may not expect the highest possible returns, but they'll likely experience smaller swings during market downturns. A balanced investor could choose something closer to 80% stocks and 20% bonds, giving them a combination of growth and stability. And then there are the young investors with very long time horizons who choose to invest almost entirely in stocks ETFs because they understand that although the market can be volatile in the short term, history has shown that time has generally rewarded patient investors. But again, these aren't recommendations. I just want to, give you simple examples to show you that your portfolio should match your ability to stay invested, when the markets become uncomfortable, because the thing that matters the most is to stay invested. And that brings me to what I think is the biggest mistake investors make. It's usually not choosing the wrong ETF or anything like that. It's abandoning a good plan. When the market drops 10, 20% or even 30%, people naturally become nervous. Headlines start predicting the crashes, social media fills you up with panic, and suddenly people feel like they need to do something. Everyone's panicking. So what happens after? They sell their investments. Unfortunately, the stock market doesn't send, invitations when it's about to recover. And in history, some of the market's biggest gains happen immediately after some of its worst days. If you're sitting on the sidelines waiting until everything feels safe again, there's a good chance that you'll miss a large part of the recovery. Think about it this way, like imagine planting a tree because you want shade one day. After a few months it hasn't grown so much, so you dig it up and plant another one, and a year later you repeat the process. If you keep restarting every time your progress feels slow, you'll never enjoy a big tree to give you shade. Investing works in a very similar way. The biggest advantage you have isn't finding the perfect ETF, it's actually giving your investments enough time to grow. That's why consistency matters so much more than perfection. People often spend weeks trying to decide between BOO or IBV or SPY or another similar ETF. While those decisions aren't completely meaningless like I've been talking about in this video, they usually aren't what determines whether someone becomes wealthy. And the difference between investing consistently for 30 years and waiting another 5 years to get started is often far, far greater than the difference between two excellent ETFs. Let's just look at a simple example. Imagine there's two people. The first person invests $500 every month starting at age 25 and earns an average annual return of 10%. Then the second person waits until age 35 to start investing the exact same amount with the exact same return. Even though the second investor contributes just as much every month, they'll likely end up with hundreds of thousands of dollars less just simply because they started 10 years later. And that's the incredible power of compound interest. Your investments don't just earn returns. Those returns begin earning returns of their own. Over decades, that snowball effect becomes incredibly powerful. And here's something I think a lot of beginners overlook. Building wealth usually isn't about making one brilliant investment. It's about making hundreds of boring decisions correctly. Investing every month, ignoring scary headlines, continuing to invest during recession, keeping your costs low, being patient, and watching videos like this. And that's why maybe you should consider liking the video if you like it so far. But again, those habits probably won't make for exciting TikTok videos, but they've helped millions of ordinary people build extraordinary wealth over long periods of time. And before we finish the video, I want to leave you with one final thought. Think about this. A lot of people spend years asking what's the best ETF, and I don't think that's necessarily a wrong question, but I think a better question is what's an ETF I can confidently stick with for the next 30 years? Because the best investment isn't necessarily the one with the highest return over the next 12 months, but I think it's the one that keeps you invested long enough for compound interest to do what it does best. So if I woke up tomorrow with an empty portfolio and I had to start over from scratch, I keep things very simple. I invest consistently, I avoid trying to predict the market, and personally choose a low-cost S&P 500 ETF like I said that I would pick VOO. Not because it's guaranteed to outperform every other investment, but because I believe simplicity, diversification, and consistency gives me the best chance of reaching my long-term financial goals. So if you found this video helpful and I helped you understand ETFs a little better, please let me know down in the comments. I'd also love to know which ETF you're investing in, if any, or if you're maybe still trying to decide. And if you're just getting started, make sure to subscribe, because in the next videos I'll be talking about similar topics, and I'll think they'll be very valuable for anyone listening. Thank you so much for watching, and I'll see you in the next one.